Hello, everybody, and welcome. My name is Jordan Dechtman, and I am the founder and CEO of Dechtman Wealth Management. Joining me on today's call is Sam Dechtman, CFP, Wealth Advisor at Dechtman Wealth Management. Today, we're going to share ideas in regards to market insights, and without further ado, we're going to jump right in. This next slide discusses our disclosures. It's a requirement, and we can move on to the next slide. So our agenda for today is very straightforward. We're going to cover these 5 topics. We're going to talk about the most recent historic volatility. It's been unprecedented, and we're going to address that. News, news, news. Lots of news, and we're going to talk about what's happening and where we think things are moving. Number 3, what will the recovery look like? And we have a definite opinion and a philosophy and a direction that we think ultimately is going to work in an investor's long-term favor. The benefits of diversification, something that we talk about all the time. And lastly, rolling investment returns.
So first, we're going to dive into the historic volatility that we're seeing. Now, I'm sure by just watching the news or reading different articles online, you've already gotten the feeling that maybe we are in an extremely volatile period in history. But if we look back at the S&P 500, going back to 1950, these are the 15 worst calendar days. And if you take a look at the 3 that are highlighted here, you can see that just from the month of March, there were 3 of the worst 15 days of the S&P 500 going back, 70 years now? So that gives a little bit of context in terms of some of these big moves, 3, 4, 5, and in these cases, 7 and 7.5, 9.5, and 12. And in fact, this was the quickest the market has ever entered a bear market. It entered a bear market in about 25 days. So things moved very quickly this time around due to the different conditions, and wanted to give you some context in terms of how this has looked historically. Now, in terms of the news, we've already seen a lot of negative, very scary articles out there, if you will, and we want to caution you that the news may not settle down for some time. You might see more articles, you might see more information related to more cases of infection and deaths, specifically in those hot areas of the United States, being New York City, Detroit, and New Orleans. You might see more news on businesses being negatively impacted. As long as we continue to remain in these very strict social distancing measures, that puts a huge strain on small businesses and leads right into our next bullet point here, layoffs and a potential recession. Now, we've already seen a record number of folks that have applied for unemployment in a 4-week span, about 17 million. And it's fair to assume that, we're likely have already begun a recession, but we won't know that we're in one until a good time afterward. And lastly, we have the unemployment rate increasing. With more folks being laid off and businesses being shut down, you're seeing the unemployment rate jump back up. Now, having said that, just because we think the news will continue to be potentially more negative than positive in the near term, doesn't necessarily spell that it would be a bad thing for stocks. Now, if we read this top bullet point here, the equity markets usually recover before the news flow gets better. And here's why that is. On a previous video, we discussed the difference between the stock market and the economy, but it's worth repeating for you all here today. The stock market is forward-looking based on future expectations. The economic data in the economy are based on what has already occurred. So it's looking back at what had already happened. So when we've already seen those massive historic volatility days, that is the market already pricing in, already using their future expectations to assume the worst, that we're going to have a very terrible recession, that the unemployment rate was going to jump as much as it did, that all of these small businesses may have to temporarily stop what they were doing for a period of 1 to maybe 3 months. And so the stock market has the ability to recover quicker than the economy. And this is a great quote here at the bottom by a very famous investor in 2009, where he says, "Finally, be aware that the market does not turn when it sees light at the end of the tunnel. It turns when all looks black, but just a subtle shade less black than the day before." Now, let me put this into some context and what this could actually mean in terms of the market. If the market is already pricing in that the GDP in the second quarter will go down by 15 to 20%, if the GDP in the second quarter only should go down, let's say 10%, that would be very positive news for the stock market. Even though it goes down, the expectations that it was going to be much worse. So anytime you can beat expectations in a positive way, that means that things are positive, which goes to my point that the equity market can recover before the economy starts to look like it's back fully to where it was before.
Well, on that note, what will the recovery look like? And here we have alphabet soup. Are we going to have a U-shaped recovery, L, V, or W? And the question is more like the answer, we're not 100%. A lot of it factors in on whether or not we have a vaccine sooner than later. Also depends on continued improvement where we see new cases going down, particularly in the hot spots. But we see the recovery improving and improving significantly. If we take a look at this next slide, the conditions that support a V-shaped recovery, and this is what we're thinking and the reasons why. First item here is monetary stimulus. Tremendous monetary stimulus, cooperation between both the federal government and the Federal Reserve. Interest rate cuts is enormous, and interest rates are right at 0%. Secondly, the new fiscal stimulus package, the CARES Act, produced over $2.2 trillion in the U.S. alone, not to mention globally what other nations and other European allies are looking at. And number three, the consumer is going to benefit from the lower interest rates and ultimately lower oil prices. We think that that's a tremendous benefit over the long term. And lastly, businesses wanting to make up for lost production. Businesses are chomping at the bit and they're ready to get back to work. Hopefully, by the beginning of May, things will start to ease into back to normal again, and we think that all of these considerations support a V-shaped recovery.
And one graph to accompany those last conditions why we feel a V-shaped recovery is a possibility is that households entered this in much better shape. So what you're looking on your screen right now in terms of the graph is the debt servicing cost. So what does that mean? This blue line is charting how much of a household's income is required towards debt payments. So your mortgage, your credit card, your other types of insurance payments that you might have, or, again, other debts that need to be repaid. So if you look here on the gray bar on the right-hand side, this is when we had the financial crisis, 2008. And you can see that it really peaked. and we were close to about 13% of households' income was going towards debt service. And as you can see, over the past 10, 11, 12 years, that number has slowly and steadily decreased to where we were at the beginning of this year. We had the lowest debt service ratio going back to 1980. So for the past 40 years, households were using less of their income in order to pay these mandatory debt payments. So we think that while folks, of course, have lost their jobs, but with the increase in unemployment benefits that we've seen in the latest government stimulus package, we're hopeful that this will be a major reason why we should hopefully see a V once we're on the other end. And how have markets performed historically after pullbacks? You can see here that this is a list of every bear market going back to the Great Depression in 1929 to 1932. But to highlight the main example, which we saw in terms of the last bear market, that was October 2007 to March 2009, within 6 months of the financial crisis, you saw the market go up almost 53%. 12 months after that, 68.6, and 18 months out, still over 63%. So no one knows exactly if we've hit the bottom yet or if we've already started this process of recovery. But one thing we do know, and you can look at every single one of these examples, is that once a bear market ends and once we get past the worst of this, the recovery is usually dramatic. It is usually significantly higher, and we always end up recovering and reaching new highs.
Something that we continue to talk about here at Dechtman Wealth Management is diversify, diversify, diversify. This particular chart shows the different asset classes from 2005 all the way through the end of last year. And the top line represents the top performing asset class in that given year. And the bottom line represents the worst performing asset class in that given year. However, the idea of having a well-balanced and well-diversified investment strategy is illustrated by having an asset allocation approach where you're going to be more consistent, more stable over the long term. And ultimately, that's how you're going to get better returns with less risk. So when the markets go through a volatile period like we're experiencing now, the knee-jerk reaction is to make changes and to do something different, when in fact, by doing nothing may be in fact the best medicine that you could take for the long term. Diversify, 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 and that's what we're doing here at Dechtman Wealth Management. So we want to look at investments over time. We always say that investing is a long-term process, and it's not timing, but it's time. So if we take a look at a range of stock, bond, and a combination of stock and bond returns, you can see that the 1 year, 5-year, 10-year, and 20-year rolling average is more positive the longer you look out. So on a 1 year, the more volatile equity markets, a little lesser in the bonds, and a little lesser when you have a blended portfolio 50-50. Moving it out 5-year, 10-year, and 20-year, it's positive in virtually 99% of the cases. So again, we want to have the long-term perspective and making sure that you have a proper balance between stocks and bonds.
And one thing very important to point out is a portfolio that was a 50-50 blend over the past 70 years, I'm looking at this 5-year rolling return, always had a positive performance. So for the past 70 years, if you had a 50-50 portfolio over every single 5-year increment, there was always a positive return.
So we want you to utilize us as a resource. Please give us a call. Something that we've talked about in other communication was regarding to the new stimulus bill, where the government has allowed the waiver allowing you to stop your RMDs for 2020. So if you are at that age where you're taking RMDs, you can stop it for this year. Even if you need other money, it can be taken out of another account. The other point I'd want to mention on RMDs is part of the new tax law that went into effect this past year. You can waive your RMD, delay your RMD until age 72. So it used to be age 70 and a half, now it's age 72. The next item here is a cash plus strategy. And what's really surprising and really kind of helpful is when we're getting calls and someone says, hey, I have money in the bank and I want to put that to better use. I'm not making anything in the bank, but I want to keep it safe and secure. This is where the cash plus strategy comes into play. It would be a fixed income portfolio, and it would be a very safe, stable, and secure approach where you can have liquidity, you're not tying it up, you have immediate access, but we'd obviously want to talk to you in more detail to make sure that that's right for your situation. We're obviously not meeting with anyone face-to-face in person, in our office, but regardless, we're here. We're working full-time at the office. We are available, and we'd like to sit down with you over the phone and review your overall questions and concerns. Please call us. Our phone number is 303-741-9772. Or you can send us an email, or you can visit our website. But we would love to hear from you. This is our job. We love what we do. We love helping you. This is a very challenging period for all of us, but we'll get through this together. And on behalf of all of us at Dechtman Wealth Management, we want to say how grateful we are to have the privilege of serving you. Thank you again for your time and attention. Have a wonderful day.